The S&P 500 just exited correction territory, and the bulls are taking any news as good news to rally. But after a very strong 20-year auction sent yields lower, the bears who were expecting a weak auction were all but squeezed out of their positions. And despite what the stock market is signaling, the economy continues to show signs of weakness. And with a shortened trading week ahead and low volume expected throughout the week, today we answer the question, when will the bears get their pullback? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell, let's get into it. Last time I saw this much green in technology was last week because all this market does is rally. But we had strong rallies in technology and communication services, they were the leaders. But it wasn't just all tech and comm services. What it really was the best stocks in each sector. Coca-Cola, Eli Lilly, Amazon in cyclicals, Tesla, Boeing, the best companies in every sector were the ones performing, and those that are subpar got sold off and rotated into the higher quality names. Now, Mondays have been very good for the stock market. The S&P 500 was up 0.7% for the day, and the Nasdaq a very strong 1.21%. You can see here that the S&P 500 annualized returns on Monday is 70.4%, and you could probably add now 71.2% based on this week's close. And this all happened because of a very strong 20-year auction, and it was a very strong auction met by incredible demand. We know that the longer duration assets haven't seen the demand that the shorter notes have, but it's very good to see strong demand in these longer duration assets now coming into the market. And again, this was a big tailwind for equities as we saw yields, especially from the 3-year downward, move significantly lower on the day. And futures is pricing in some very crazy stuff. Have a look right here. 14% chance of a 50 basis point cut in May. Wild. We are still expecting a 50% chance of a 25 basis point cut in May, as well as a 30% chance, close to 30% chance of a 25 basis point cut in March. So all in all, the market is kind of front running these rate cuts, but we still need to see them materialize first. Otherwise, the market will sell in the May period. Now, last week I was showing you the returns you can expect from rate cuts. 150 basis point cuts, you can expect 26% return to 33% in the 20-year and 30-year. But here are the stats for gold when the Fed has stopped raising rates and then cut them. You generally see that we have very strong rallies in gold. Here, 2000 to 2004, a 66% rally. From 06 to 2012, 189%. 6 years, that's something like an 18% compounded annual growth rate. Look in 2020, 15% increase. And here we are again, potentially eyeing rate cuts. And what does that mean for gold? It's yet to be seen. But lower rates often mean stronger gold, and stronger gold means a weaker dollar. And we are actually seeing a weaker dollar, guys. The dollar index, DXY, is sitting at 103, and it's in the middle of its 52-week range and down nearly 0.5% on the day. And according to Bloomberg, we could expect further weakness into 2024. The dollar has rarely gained for more than 3 years in a row over the past half century. You could see that this dollar has been very strong over the last 3 years, but this is a very rare occurrence and something I want to bring your attention to now. But when we've had huge rallies in the dollar, the next year has often seen very steep declines. You can see this is true right here, a steep decline, and right here, a very steep decline. So we've had a strong rally in the dollar, and if the dollar does weaken, this is gonna be supportive for equities because 40% of all S&P 500 derive their earnings from overseas, and a weaker dollar is better for overseas earnings. But on the topic of dollars, the amount of money in money market funds, and there is $5.7 trillion in money market funds. As yields turn lower, we should see more of this cash rotated into equities because the risk-free rate declines, the equity risk premium increases, and this makes equities more attractive. But are equities a buy? And according to the bullish percent index, probably not right now. If you've missed this rally, it's a bit of a shame. If you've been following me since late October, you know that I said buy here with everything you have. And based on the bullish percent index, there probably is still a bit more runway to go before we get some form of a decent sell. And this probably means we go higher into the end of November, December, again, based on the bullish percent index, which is based on a point and figure chart. And stock charts right here, now this is again stock charts, guys, have their bullish price objective 5,300. Very, very bullish. Now, this is not statistically significant at all, but it is a stat we can look at and add to our bull case. However, we do continue to see CTAs increase their positioning as the S&P 500 continues to rally. You think based on this huge rally would come on the back of CTAs being significantly more long. You think they'd be up in the 40% range, but no, they're at about 15-16% long positions. So this does have room to run. The bullish percent index has room to run, and everybody is chasing this rally because we know that fundies are actually underweight equity exposure. They're sitting at about 72% on the NAM index. So only about 72% of their fund is in equities, when normally, they can go up to as high as 200% leverage long. But it's not all good news. There are some worrying signs showing up in the options market, and this is the skew index. We're approaching the $50 level, which is a very critical level. And essentially what this means is that puts are cheap relative to calls, and there's a bit of complacency in the market when it comes to bulls. Everybody's just buying, and when it does get to these levels right here, like it did in July, late August, and we see a spike up, this was often followed by sharp declines in the S&P 500. Now, looking at some unusual options activity, it was a fairly average day of volume, and it's going to be pretty low volume or fairly average volume this entire week. But we did see right here, XLE, the energy fund, did see quite a bit of volume come into it, and to be expected. Energy is a pretty hot topic of conversation right now, especially oil. And 3 times a 90-day average volume and 66 million puts against 6 million calls. So there's very bearish sentiment here on energy, as well as the Russell 2000. More calls were bid up last week, but you could see that it has flipped back to the put side. So we'll see what the Russell does for the rest of the week leading into Thanksgiving. If you actually look at total volume, still very skewed towards the calls here, and hopefully this can normalize for a much healthier rally moving forward. And again, just 34 million total options volume in there today. Let's talk about oil. Oil prices rose 2% overnight, and this is on top of the 4% increase on Friday. And this is because the market is anticipating OPEC cuts. Traders are front running the fact that OPEC will implement additional production cuts in their meeting on Sunday in response to the drop in oil prices. And while the market is pricing in cuts, I'm not actually sure that Saudi can afford to cut production costs much more, because here's the thing, Saudis need $90 to $100 oil to remain in a budget deficit. However, there comes a point where cutting your initial production just wanes on the fact that you're producing less barrels. So as well as the price dynamic, they actually need to look at the barrel dynamic as well. The Saudis are in a very, very tough position. They can't really cut production much more, but they do need higher prices, and especially with the US producing so much oil. Now, I don't know too much on the dynamic, but what I can tell you is that Bank of America is expecting oil to be the best performing asset class of 2024. They're forecasting an 11 to 13% return for the year. So maybe where oil is right now, around the $77 mark, this could actually be a good price to get in. But I much prefer equities over any type of commodity, especially right now. Now, guys, earnings are still ongoing. It's still, I believe, the final week for earnings. Not a lot happening. We did get Zoom's earnings. They actually produced pretty good earnings. They were bid up after hours, but we have a big one. Nvidia is reporting, and so much of the S&P 500's earnings per share comes from Nvidia, especially this quarter. And this is the one we're waiting for. If Nvidia beats results, expect this to rally. Now, I do have the gamma for Nvidia, and have a look right here. This is where we are right now, the 504 level. And this is the core resistance. So we're sitting above the core resistance. If Nvidia beats earnings, I expect them to run all the way to 550. As you can see, the market is very bullish on Nvidia's earnings. I personally am not in Nvidia at all, except for my Nasdaq positions, which is the index. But let's move on to seasonality. Okay, so the Tuesday before Thanksgiving up to the second day of the new year, these are the returns we can expect. So the S&P 500, we can expect an average return of 2.57% and a median return of 2.36%. 58 up years, 15 down years. That's an 80% win rate with an average win of 3.78% and an average loss of 2.13%. The risk to reward here, pretty good, but it gets even better in the Russell 2000. Almost a 2-to-1 risk to reward. Sorry, almost a 1-to-2 risk to reward. 2.89% average loss, 5% average return, and this is about the same stats, 34 wins, 10 losses on the Russell 2000. And we can expect more, and I think we can actually go even higher, and this is because this is the gamma exposure for the S&P 500. Now the call resistance last week was 4,500. We moved up to 4,600 after options expiry, and what essentially that means is call resistance was right here. This used to be the call resistance. We have now moved up to this level right here, and essentially what it means is that traders after options expiry have repositioned themselves to the 4,600 strike, and this is how I see things playing out. If Nvidia beats earnings by the end of the week, we very likely finish at 4,600. So everything is dependent on Nvidia's earnings. Now we do often see a dip into this week based on seasonality. Normally we see a dip in the third week of November, but with the way things are going now, with the way things happened in today's trade, we're just moving higher. Like we're totally skipping this part right here. But again, everything is going to be dependent on Nvidia's earnings, guys. But let's hop on the chart and have a look at the S&P 500. Okay, so this is the SPY, the daily chart. A very, very bullish day. We opened up here, sort of like waited for the data to come in, the auction results, and when it came in, we just absolutely bid up. Now, we did see a bit of selling towards the end of the day. I literally think this is just bears trying to like re-enter their shorts position because they were squeezed after the 20-year auction. So bears entered right here, but it's just another tailwind. I mean, we've broken above this high, closed above the 454 high, which was the high in September, and this is very bullish. We've exited correction territory. So many gaps were left right here in the SPY, and to be honest, I think we go higher. I think we go higher into the end of the week, especially if Nvidia's earnings come in as expected or they beat. We're probably going to bid up to this level right here, the 460 level. But Nvidia's earnings aren't the only big thing this week. We do have FOMC minutes being released on Wednesday. Let's move on to dark pools. The S&P 500 3x bull shares. There isn't really much to go by. I would normally say that, you know, having the second biggest trade since inception come in here could be bearish, but to be honest, these trades were huge all the way on their way up, and look at what we've done so far. So don't fight the trend. I wouldn't look at this as anything significant. Based on what we're seeing right here, I would consider this more bullish than anything else. But thank you so much for watching, guys. If you like this video, please subscribe, leave a like, leave a comment. You know I love you guys.